Good morning. This meeting will come to order. This is a public meeting of the Commodity Futures Trading Commission to consider issuance of a proposed rule on energy position limits and hedge exemptions on regulated futures exchanges, derivatives transactions, execution facilities, and electronic trading facilities. I note for the record that the public notice of this meeting was given on January 7th, pursuant to the provisions of the Government and Sunshine Act, and I'd like to welcome members of the public, market participants, and members of the media here today, as well as welcome those listening to the meeting by phone and watching live on webcast. I'd like to thank the staff for all of the work they have put in to drafting today's proposal. The staff worked countless hours on this complex subject, researching the statutory and regulatory history of position limits both in the agriculture and energy markets. They spent a lot of time reviewing how the markets for these commodities function and the economic research on it. I thank them for their thoughtful recommendation for how the Commission can best comply with its statutory obligation and to promote the fair and orderly functioning of the markets. In addition, the staff has done a thorough review of how the agency and the exchanges have granted exemptions from limits and the comments submitted in response to the spring concept release last year, and they have provided a thorough recommendation on how to bring uniformity to these exemptions. Today's meeting is an important step in a long process. It builds upon earlier work of the Commission when, under Acting Chairman Mike Dunn, it issued a concept release on risk management exemptions last spring. It follows upon the important hearings we had last summer with regard to energy position limits. And should the Commission vote on this proposed rulemaking to make it public, there will be a 90-day public comment period during which the Commission will accept comments on the proposal, and the instructions on how to submit those comments can be seen on our website, www.cftc.gov. I'd also like to thank my fellow commissioners for all of their input. Their comments to the staff have been thoughtful and constructive in arriving at today's proposal. Separately, the Commission is interested in hearing from the public as to issues related to the trading of futures and options on the precious metals markets, silver and gold, and to consider the appropriateness of position limits in these markets as well. And I hope that we'll be able as a Commission to have a public meeting on this separate topic in the beginning or early part of March. General Counsel Berkovitz will now provide background on the agency's history in setting position limits and appropriate hedging exemptions. The Commission's Director of Surveillance, Steve Sherrod, will then present details of the proposed rulemaking. Both will then take questions from the full Commission. So I thank you, and I turn it over to you, Dan.
Thank you, Mr. Chairman and Commissioners. I will provide a short history of position limits in futures markets, including the bona fide hedge exemption from these limits. Since 1936, the Commodity Exchange Act has directed the CFTC to establish such limits on trading as it finds, quote, are necessary to diminish, eliminate, or prevent, unquote, the undue burdens on interstate commerce that result from excessive speculation in those commodities. After the passage of the 1936 Act, the Commission set position limits for wheat and other grains. Later, the Commission established position limits for cotton and several other agricultural commodities. Over the next several decades, for some of the commodity futures that were not traded on federally regulated futures markets, such as the livestock commodities, the exchanges set their own position limits. In 1974, the CFTC was created and its jurisdiction expanded to include not just futures contracts for the commodities listed in the CEA, but for futures contracts for any commodity. In 1981, the Commission adopted a rule to require the exchanges to establish position limits for commodities that were not already subject to Commission-set limits. Prior to 1993, the Commission used several criteria to establish the levels of the single-month and all-month combined limits. These included the breadth and liquidity of the cash market, the financial exposure of traders in the event of limit price moves, and the extent to which limits would constrain trading. In 1993, the the Commission adopted by rule an open interest formula for determining position limits. This is the basic formula that is in the proposal being discussed today, as Steve will describe. The Commission also permitted exchanges to establish position limits based upon the open interest formula. In 1992, the CFTC granted an exemption from the position limit requirement to permit the CME, the Chicago Mercantile Exchange, to use position accountability instead of fixed limits for several of its financial contracts. Position accountability levels were not fixed limits, but rather levels that would trigger a review of a trader's position and allow the exchange to either prevent a trader from increasing its position or force a reduction in position. 6 months later, the CFTC determined it would also grant requests to permit position accountability to be used for highly liquid energy and metals contracts. In 1999, the Commission issued a rule that formally recognized the practice of position accountability in months other than the spot month. The Commodity Futures Modernization Act of 2000 statutorily authorized the use of position accountability. The CFMA did not alter, however, the Commission's mandate or authority in Section 4A to establish position limits as it finds are necessary. Since 1936, Congress has stated that position limits should not apply to the use of the futures markets by commodity producers or users to discover prices or manage their price risks. Section 4A originally defined a bona fide hedge transaction to mean sales or purchases of futures contracts that were offset by purchases or sales of the same cash commodity. In 1974, the Congress repealed the statutory definition and gave the CFTC discretion to define what constituted bona fide hedging, provided that its definition permits commercial users of the commodity, quote, to hedge their legitimate anticipated business needs. In 1977, the Commission codified the definition of a bona fide hedge transaction in Regulation 1.3Z, which remains in place today. In 1987, the CFTC clarified that the bona fide hedge exemption should apply not just to firms using futures contracts to reduce their exposures to risks in the cash market, but could also include balance sheet and trading strategies that are risk-reducing. Several months later, the CFTC interpreted its definition of bona fide hedging transactions to permit exchanges to grant exemptions for various risk management transactions. It also required that applicants be typically engaged in the buying, selling, or holding of cash market instruments, and that the exchanges monitor the use of these exemptions to ensure there were no market disruptions from large positions. In 1991, the Commission staff granted a bona fide hedge exemption to a swap dealer who was seeking to manage its price risk resulting from swaps it planned to enter into with investors seeking exposure to commodity indexes. Similar hedge exemptions were subsequently granted to other swap dealers. The first position limits for energy commodities were imposed by the New York Mercantile Exchange, NYMEX, when trading in crude oil began in 1983. In 1984, the Commission imposed position limits on heating oil and gasoline, and in 1990 on natural gas. In 1997, the Commission approved increases in the speculative position limits for crude oil based upon the open interest formula. The chart that we're showing now is the NYMEX all-month combined position limits. You can see from the chart the initial limits on crude oil were set in 1983 for crude oil, in 1984 for gasoline and heating oil, and in 1990 the first position limits were established on natural gas. You can see a number of times the crude oil, the all-month combined limits were increased for crude oil. They were increased for natural gas, which is the green line there, as well. And gasoline and heating oil were increased in, I believe, 1991, but remained constant through the 1990s. The last two increases in crude oil and the last increase on natural gas were based upon the open interest formula that I mentioned that Steve will describe in more detail. You see that the line also ends in 2001. These NYMEX position limits In 2001, NYMEX certified to the Commission that it would be using position accountability for the single-month and all-month combined limits rather than the fixed position limits, and that was consistent with the designated contract market core principles in the Commodity Futures Modernization Act and prior CFTC regulations on that. So the last levels of position limits became the new accountability levels in 2001. Thank you.
Shared.
Good afternoon, Mr. Chairman, Commissioners. Today, staff is recommending the Commission approve a notice of proposed rulemaking to set federal speculative position limits for futures and option contracts in certain referenced energy commodities. In addition, the notice of proposed rulemaking would establish a uniform process for the Commission to grant swap dealers limited risk management exemptions for certain swap transactions in lieu of a bona fide hedging transaction exemption. The proposed rulemaking would build on the Commission's experience in setting position limits in certain agricultural markets to reestablish the all months combined and single month position limits in the energy markets. The proposed limits would use the same open interest formula that Dan mentioned. It's the one the Commission has used in its guidance to exchanges. The limits would be responsive, though, to the size of the market and administratively reset on an annual basis rather than change only by rulemaking. The proposal would impact the reporting markets of NYMEX and the Intercontinental Exchange, or ICE. The proposed limits would apply to reference energy futures and option contracts based on Henry Hub natural gas, light sweet crude oil, that's often called the West Texas Intermediate, or WTI, New York Harbor No. 2 heating oil, and New York Harbor gasoline blend stock. In reestablishing these all months combined and single month limits to these energy markets, staff recommends further extending the aggregation concept in the Commission's federal agricultural position limits. The proposed energy limits would establish a two-tiered system of limits in all months combined and in single months. These limits would apply across economically similar contracts. The first tier is an aggregate limit that would apply to positions across physically delivered and cash-settled contracts and across reporting markets in a reference energy commodity. The chart that I have up now illustrates the general increase in the percentage of the reference energy market that's comprised of cash-settled contracts. A historical approach to establishing position limits would be to set separate limits by individual contract. That is, set separately for each physically delivered contract and each cash-settled contract. However, since the cash-settled contracts are economically similar to the physically delivered contracts, staff recommends limits be established and applied to a trader's aggregate position. The aggregate limit would restrict a trader from establishing extraordinarily large positions on the same side of the market across all contracts in a reference energy commodity. So this means all positions of a trader in related contracts would be aggregated regardless of the reporting market. The second tier is a class limit that would apply to positions in economically highly similar contracts, that is, to contracts in a particular reference energy commodity on a single reporting market that are settled in the same way, either cash settled or physically delivered. The class limits would restrict a trader from establishing extraordinarily large positions on opposite sides of the market in physically delivered contracts and cash settled contracts that are in the same reference energy commodity. In each of these two tiers, there would be limits on all months combined and single months. The aggregate all months combined limit would be set based on the open interest formula that Dan mentioned. The formula sets the level of the limit at 10% of the first 25,000 contracts and 2.5% of the open interest beyond 25,000 contracts. The single month limit is set at 2/3 of the all months combined limit. Each class limit for those positions in all months combined would be set at 30% of a contract's total open interest for that class on that reporting market, but limited to a level no greater than the aggregate limit. The single-month limit in a class is set at 2/3 of that class's all-months combined limit. And this table illustrates what the position limits would have been if they had been in effect over the last 9 years, and what the limits would be in effect for looking prospectively ahead. These are what the limits would be beginning March 1 of 2010 if the Commission had adopted the proposal as a rule. Notice that proposed rulemaking also includes provisions relating to exemptions from the position limits for bona fide hedging transactions and for certain swap dealer risk management transactions. The notice also sets out an application process that would apply to swap dealers seeking a risk management exemption from the position limits, as well as related definitions and reporting requirements. The notice also includes provisions regarding the aggregation of positions under common ownership for the purposes of applying the limits. Should the proposed regulations be adopted, staff estimates that the total number of traders with significant positions that could be affected at the time of implementation going forward may be approximately 10 traders. This chart illustrates how many traders would have been potentially restricted by the limits had the proposed limits been in effect during calendar years 2008 and 2009. The data represents a weekly snapshot of traders as of each Tuesday, consistent with the way we disclose commitment of traders reports to the public. For crude oil, the maximum number of unique owners affected by the all-months combined limits would have been 2 on any given Tuesday over that 2-year period. And there were a total of 3 unique owners in crude oil over that 2-year sample that would have been affected. Across all 4 energy commodities, there would have been 23 owners affected. By affected, I don't necessarily mean restricted. The traders may have been eligible for a bona fide hedging exemption or a swap dealer exemption. From the data, though, it appears that 7 unique owners would likely not have been eligible for an exemption. This chart shows historically if the limits had been in place when Amaranth was trading in 2006, that their all-months combined position would have been trimmed. The red line indicates what the level of the limit would have been. And this chart shows for the single month that if the limits had been in place, the red line again being the limit, that Amaranth's positions would have been restricted by the proposed limit structure. This chart illustrates the impact the limits would have had on the U.S. oil fund if the limits had have been in place during 2008 and 2009. At their peak, they would have been restricted. Currently, that would not be applicable. In the U.S. natural gas fund, positions under the limits, if they had been in effect in 2009, would have been restricted for a number of days as well. But I note that the proposed federal speculative position limits on energy contracts would be in addition to and not a substitute for a reporting market's existing speculative position limits in the spot month and their accountability requirements. The reporting markets are self-regulatory organizations with an independent responsibility for adopting and implementing appropriate position limit or position accountability rules. Under exchange position accountability rules, once a trader has exceeded that level in terms of outstanding contracts held, the exchange has the right to request supporting information from the trader for the size of its position and may order a trader, as Dan mentioned, to reduce or not to increase its position further. This notice of proposed rulemaking does not propose regulations that would classify and treat differently passive long-only positions. The notice would, however, solicit comment on specific issues related to large passive long-only positions. In particular, the notice solicits comment on how to identify and define such positions and whether such positions should, including collectively, be limited in any way. That concludes my prepared remarks, and Dan and I would be happy to answer any questions you may have.
I want to thank both Dan and Steve again for not only all the work that led up to today, but the excellent and clear presentations. I think following the rules, but I might note this is the first time in 8 years that this commission has met in a public meeting to consider a rule. So if I look like I'm learning on the job here, I hope that's understood. But I think that the transparency that we bring to such a meeting is an important thing, and I would hope to bring such transparency to further commission actions in the future. But at this time, before the public debate and questions, I'd like to entertain a motion to accept the staff report and publish the proposed rule.
So moved.
Do I hear a second? Second from Commissioner Amalia. With the staff report so moved and seconded, we'll now have an opportunity for commissioners to ask staff questions and to discuss the proposed rule. I think it says here that I'm supposed to actually, I guess, recognize you first, Scott. That's what it says in my list here. Or do you want?
On the questions, I'd be happy to defer to seniority.
All right, so we'll do the questions in seniority, and we'll do the closing statements in reverse seniority. How's that? Is that all right? I have had a great benefit of working with the excellent staff and asking a lot of questions. I've even had the benefit of eavesdropping on your embargoed briefings of the Hill and of the esteemed press. But so I'm going to limit it to just a couple of questions. Mr. Berkovitz, in terms of the history, I'd just like to understand a little bit from your perspective again, the Commission's obligations. There's been a great deal of discussion about what does it mean to protect against the burdens of excessive speculation, what findings are we to make, what findings we've made in the past. Could you help us there a little bit?
Generally, the consistent interpretation of the Commission over the Commodity Exchange Act over the years, which has been affirmed by a number of statements from the Congress, but our consistent interpretation of the Act over the years is that the direction and authority to establish position limits to prevent the burdens of excessive speculation is prospective in nature. The Congress, in enacting the statute, made the finding that excessive speculation can be a burden and directed the Commission to establish such position limits as may diminish or prevent such burdens. So necessarily this is a forward-looking endeavor. The Commission has traditionally found that unduly large positions relative to the size of the market can pose several problems. It impairs the price discovery process. The individual traders who have large positions tend to cause unwarranted price movements, and that if large traders have to liquidate those positions, it can cause also unwarranted price movements. So traditionally, the Commission has looked to the level of concentration, the level of size of an individual trader, and tried to put some limits on how big an individual trader can be or how large the market, the existing size of the market, what size of trader it can accommodate. The Commission does not need to find that there has been or there might in fact be at the moment excessive speculation or some type of unwarranted fluctuation in the price of that commodity, merely that the limits are an effective tool forward-looking to prevent such potential excessive burden. So it's really a forward-looking rather than necessarily a reverse finding.
And secondly, in terms of our statutory regime, what is our responsibilities, if any, with regard to price levels? I mean, are we a price agency or are we not?
The direction in the Commodity Exchange Act does not pertain to any particular price level. It's to ensure a fair and orderly market, and that if there is a legitimate price discovery process, then the price is what the price is. We are not a price setting or an agency that makes a judgment about the level of prices. Rather, it's the process by which prices are set on the exchanges.
So it would be correct to assume we're not a price setting or regulating agency. We regulate the markets, as you said, to be fair and orderly.
That's correct.
And position limits have in the past been interpreted to address, along with other things, address the concentration on the marketplace.
That's correct. The basic goal of the Act is to enable these futures markets to enable the producers and the users of the commodities to discover prices and to hedge against their anticipated price changes, not to set price levels.
And then one other sort of history question, and maybe it's for both of you, but so what happened in 2001? We have, for about 20 years in the energy markets, the position limits were set. You showed a very helpful graph on those levels in the energy markets. We've, since the 1930s, set them in the agricultural markets, either here or at the exchanges. So what, from your perspective, legally or otherwise, happened in 2001 that, in essence, it stepped away from something that was done for so many decades?
Traditionally, as I mentioned in my statement, there are commodities for which the Commission set position limits. Those were a number of the original agricultural commodities. When the Commission's jurisdiction was greatly expanded in 1974, there came in all these other commodities. The Commission determined in the early 1980s that for those that we hadn't already set limits on, the exchanges would have an obligation. In the early 1990s...
But I assume consistent with Commission guidance or something.
Exactly, and the Commission set forth the guidance on how to establish the exchange set limits. In the early 1990s, the Commission first permitted exchanges to establish what we've mentioned as position accountabilities levels. Instead of the hard fixed position limits, these position accountability levels are triggers for further review of the exchanges for positions. At first, the Commission allowed these as exemptions from the position limit requirement. An exchange would have to come in and apply for an exemption. And at first, that was used for financials, because financial future contracts, they were highly liquid markets, and there weren't actually deliverable commodities like corn or grain. The Commission in 1992 said we will also consider using our exemptive authority for energy and metals. And in 1999, it formally adopted a rule which would have allowed position accountability for energy and metals. During the 1990s, though, despite the potential availability of an exemption should somebody request it, there were none requested. So the exchange set limits applied throughout the 1990s. In 2000, the Commodity Futures Modernization Act, which was enacted and passed by the Congress and signed into law at the very end of 2000 or January 2001, established core principles that the exchange could follow. And the core principles statutorily recognized the concept of position accountability and said the exchanges could set either position limits or position accountability levels. Now, it did not change the CFTC's underlying authority to dictate that there shall be position limits, but it said if the Commission didn't, essentially it said if the Commission didn't, the exchanges could set accountability levels. Also, the CFMA allowed exchanges to certify their rules to the Commission, and they did not need prior approval of the Commission to certify a rule. Under the prior process, the Commission would have had to approve a request for an accountability level. Commodity Futures Modernization Act allowed exchanges to certify that without prior Commission review. So it was in 2001 that the New York Mercantile Exchange used the authority and the permissibility that both were permitted under longstanding Commission practice, as well as the Commodity Futures Modernization Act, to adopt position accountability rather than limits.
Is it correct that in 2001, when the exchange sort of went to accountability levels rather than position limits, it was in part because the law had been changed, and the law had, in essence, been explicit that they now only needed to address themselves to manipulation and congestion, and though it left for the CFTC to address itself to this excessive speculation, that there's sort of two concepts in the statute? I guess my question is there two concepts related but two separate concepts? One's manipulation and congestion. The exchanges have these accountability levels. And then this other concept of the burden of excessive speculation, which until 2001 we were relying on position limits, but after 2001 was sort of left to this Commission to address rather than explicitly the exchanges.
That's correct. There was no longer an explicit requirement was not an explicit requirement in the core principles to establish position limits to prevent against the undue burdens from excessive speculation. The Commission, through its guidance, has told the exchanges to do it. This has always been something that the Commission derives from the Commission's authority, and there isn't the initial obligation on the exchange to do it.
I'm fearful that I've run liberally over whatever 5-minute liberal limit I was going to do, but we're going to do a number of rounds. I do, before I hand over to Commissioner Dunn, just want to ask Mr. Sherrod, just because I want to make sure. You did mention 3 firms, Amaranth and a couple of the exchange-traded funds. Could you just address why you were able to name names, and normally this commission does not? I think it would be against our statute to name names. I just want to make sure that the public knows why you were able to do that and why we cannot name any of the other names, probably.
Well, that's correct. The statute does prevent us from disclosing the names or the positions in transactions of any individual trader. On the other hand, Amaranth was a public matter in litigation and in congressional reports. I believe Dan worked on one of those. U.S. Oil and the NG Fund publicly disclosed their positions on their website every day, so that was information that we didn't initially disclose in those cases.
Okay. I'll have some further questions on the exemption side, but I'm going to turn it over to Commissioner Dunn.
Thank you, Mr. Chairman. I apologize for a weak voice today. I've been under the weather. I would like to thank you, and I'd like to thank you and the staff for having this, and I would certainly like to thank Commissioner Summers for suggesting that we do this in this type of form. I think it's a great precedent for us in the future when we have issues of this magnitude to allow the transparency that we're asking in the marketplace to also take place here as how the Commission operates. Let me begin by just kind of making an opening statement here that financial regulatory reform is needed to address the financial meltdown of the U.S. financial markets. In my opinion, Congress and regulators should focus on 3 things. 1, providing transparency. 2, reinstating some elements of the Glass-Steagall Act. And 3, actively pursuing antitrust laws to address too big to fail. Of these 3 elements, the CFTC should have a major role in providing transparency to the markets we regulate. In my opinion, the CFTC, through Chairman Gensler, has been correct in requesting Congress to give us the authority to regulate the over-the-counter market. He has asked that we be allowed to regulate derivative dealers, bring transparency to the OTC markets, and to move standard derivatives to regulated clearinghouses. I wholeheartedly support these measures. I am concerned that the adoption of this proposed regulation without the corresponding over-the-counter regulatory authority and similar undertakings by other nations' regulators may result in less transparency in the futures markets if those presently trading on exchanges move to over-the-counter and other opaque markets to circumvent these proposed position limits. Mr. Sherrod, would you please bring up those charts that you had for Amaranth? What happened at the point, well,
I'm sorry?
well, 2 questions here. How come accountability levels don't work?
With Amaranth, the exchange was able to get information, and if they had acted affirmatively, they could have ordered Amaranth not to increase further or to have decreased their position.
Did we not have the same authority?
Our authority, it would have been in an emergency action at the Commission.
So we did have that authority.
So we had that authority. The exchange, by using position accountability requirements, could have elected to act short of an emergency, just as a normal surveillance activity of the exchange in maintaining fair and orderly markets.
When Amaranth did, in fact, reduce its positions at NYMEX, where did they go?
At the time, they went to ICE. They went to the unregulated market at the time.
Which is an unregulated market,
At the time, it was.
similar to what the over-the-counters in foreign boards of trade are. For U.S. natural gas, what happened when they were asked to reduce their positions?
U.S. natural gas entered into over-the-counter swaps in part to reduce their positions at the request of the reporting markets using their position accountability requirements.
In fairness to U.S. natural gas, one thing that they do daily is post their positions. So that is some transparency in the marketplace that we know what's happened. But the point is that in each of these cases where we're saying there was a problem in exceeding the accountability levels, when action was taken, that action resulted in market activities in an area that we did not have as much control of. I am very, very concerned that the result of putting in position limits without having over-the-counter authority and some type of agreement internationally, that we will in fact end up with less transparency in the marketplace than we currently have. Is that a concern, Mr. Sherrod, for you?
I think it's a possibility. What we've tried to do in using the traditional formula and applying it to the aggregate of all the contracts is to set an outer bound on where we think a trader would be excessively large if they exceeded that outer bound.
Excuse me, Commissioner. Can I just additionally respond? It is a concern, and it was that very concern that when the Congress saw that, indeed, when NYMEX, when the regulated market tried to put the limit on the trading of amaranth, they just went to the unregulated market. I believe that was a prime motivation for Congress to act in enacting the Farm Bill, and that's why now we have a limit on the natural gas price discovery contract on ICE. So now that market is regulated. They could not do that. In terms of somebody being able to go to the over-the-counter market, that is a real concern, and that's why the chairman and the Congress is considering, and the House bill passed does provide the authority to put the aggregate limits in the over-the-counter market. So I think as the traders seek out these other markets, the Congress has been trying to respond to that concern as well.
And I don't disagree with you. I'm talking about a timing matter here. And the concern that I have that we will do more harm in the short period than we will gain in the long period if we lose sight of what's happening in the marketplace and are unable to ensure the transparency that we currently have with those that operate on exchange. Mr. Sherrod, let me ask you a little bit, and it's unfair to you, really. But in listening to Mr. Berkowitz's history of how we got here, it's kind of like position limits and accountability levels kind of grew like Topsy. They just were there all of a sudden. Has there been any effort on our part to establish some type of risk analysis mechanism that would indicate what the appropriate position limits ought to be and who ought to be getting exemptions from those?
Well, there are two functions that can be served by a position limit. And in fact, after one of the exchanges had substituted position accountability for position limits, they re-implemented a position limit as a financial integrity measure so that no one position holder could have an extraordinarily large position that might pose a significant risk to the clearinghouse. And that was in our financial contract. The focus of today's proposal from staff is to address those extraordinarily large position holders that would have potentially concentrated market power, and by moving into that concentration power, potentially disrupt the price discovery process. We don't have any particular risk analysis of this in that regard, though.
Mr. Chairman, I'll let some of the other commissioners ask some questions, but when I come back, I would ask the chief economist to come up and explain for me the concept of co-integration.
I, too, look forward to this term, co-integration, with that, Commissioner Summers. We're going to try to just, I know I'm doing liberally, but do a second round, and if need be, a third round, but just so that we all get a chance to sort of interact.
Thank you, Mr. Chairman. I'm actually going to continue on the same sort of line of questioning as Commissioner Dunn with the accountability level discussion, because it is interesting to me that the accountability levels will, as I understand it, still exist, and the exchanges will have the ability to enforce those. But as we've discussed in previous meetings, they have been less than effective because there have always been a number of traders that were above the accountability levels. So can you discuss the levels, the way they're set, if you think they're too low, and really how are they useful for us at this point, and especially considering the kind of levels that we're proposing here?
So you'd like me to address the exchange's setting of position accountability levels?
Right, and if they would stay the same as where they are now at 30,000 versus a proposed limit of 98,000, what's the usefulness for us of that?
I think there are two separate functions that are served by the two different regimes. The proposal we have would establish a clear, bright line for a speculator to know what the outer bound is on a speculative position across, in the aggregate, across all of their contracts, in a particular reference energy commodity, in any class of contracts, whether it's cash settled or physical delivery on NYMEX in crude oil, for example. Working hand in hand with that, I think, is the function of position accountability requirements. They give the exchange the right to gather information from traders that are not members of the exchange, and they provide the exchange with the ability on a contract-by-contract basis to exercise those authorities to restrict traders or reduce positions to maintain orderly trading conditions in individual contracts. So the two regimes are not inconsistent. I think the staff proposal would simply set that outer bound to the aggregate position and to the class or group of contracts.
Thank you. And talking about enforcing that outer bounds, can you talk about how the outer bounds levels would be enforced? And in practice, when you're aggregating positions across exchanges and somebody's over the levels, how would you, in practice, tell them to get down? Can you tell them to get down on a certain exchange? And how, will you contact the trader directly? Will exchanges have that responsibility, and how that would actually work in practice?
In practice, the Division of Market Oversight surveillance staff, as you know, works hand in hand with the exchange surveillance staff in reviewing the positions of large traders. We'll use our existing large trader reporting system to obtain information as we currently do, and simply aggregate that information at the appropriate level. The CFTC surveillance staff are uniquely positioned compared to one reporting market or another reporting market to look at a trader's aggregate position across the two markets. In that case, a trader may have established a position in NYMEX, for example, that might be large but not above the limit that applied in that market alone. They might then obtain a second position in ICE on the same side of the market, and in the aggregate that may exceed what would be a federal speculative position limit. The CFTC staff then would be in the position to contact the trader, notify them that they had exceeded the position limits, and try to resolve and see whether there were any error trades or give-up trades that might have caused that violation, or if not, then the DMO surveillance staff would refer that matter to the Commission's enforcement staff for further proceedings.
And just one more quick question on this same line. Can you talk a little bit about how the proposal will work with netting, and when a trader is allowed to net across the aggregate limits?
For the aggregate limit, all of the traders' contracts in reference energy contracts, whether they're trading in different classes or different reporting markets, would be aggregated for purposes of testing compliance with that aggregate limit. Similarly, there would be netting of all the contracts that are within individual class for purposes of testing compliance with the class limit.
And is that different in the spot month than how it works? Okay.
Yes, the staff recommendation identifies a different approach to the spot month. We're proposing that the physical delivery contract have a spot month limit, and that for the cash settled contracts, a spot month limit be applicable separately to each cash settlement day. So contracts that settle on the last trading day would be in a separate spot month class than contracts that settle, cash settle on the penultimate day, for example. And by doing so, we would not allow a trader to obtain a large position on the same side of the market in one contract or one series of contracts and have an offsetting position in another contract that settled on a different day.
Thank you.
I'm going to hand over to Commissioner Chilton, but on that last point, because I think it was an important point that Commissioner Summers is raising, this difference in the spot month for cash settled versus physically settled, as I understand it, reading somewhere, this is this a recent rule that either one of the exchanges, ICE or NYMEX, has put into place, sort of cash versus? It came up in our hearings last July. I remember in the same room, one of our witnesses, but is this consistent with what ICE or NYMEX are now doing?
We're using the same approach. For the first time with the February 2010 contract months in the natural gas contract that's cash settled on ICE and the economically identical contract on NYMEX, there will be a spot month limit applicable in those two contracts separately. There will also be a conditional spot month limit that would allow a trader to have 5 times what would otherwise be the spot month limit if that trader has agreed to stay out of positions in the spot month in the physical delivery contract.
And that's what the exchange just did, and we're sort of rolling that into this.
That's correct.
Commissioner Chilton, thank you.
Thank you. I want to talk about metals first, and then I want to get back to some of the things my colleagues were talking about. I'm pleased that we've got a question on metals in here, but I want people to understand what that means and what it doesn't mean. if we received 1 million comments and they all said you should include metals in this, it is logistically impossible for us to do that. And Mr. Berkovitz, it's my understanding that that's the case because of the various requirements, Paperwork Reduction Act, and other requirements, that we would not be able to do it as part of this rule. Is that correct?
That's correct. It stems from the Administrative Procedure Act. We would have to go out with a separate proposed rule on metals.
Okay. So we look forward to getting comments on metals, but I don't want anybody to be deceived into thinking this means that X and X will happen. Now, I support position limits for metals. I think there's no reason they shouldn't be treated divergently, and I'm disappointed we're not able to do it now. One of the criticisms that has come to the agency over the years, and I'm not suggesting it's anybody's individual fault here, is that the commissioners don't have the guts to stand up to staff, and that the staff runs, either on metals or anything else, the roost. And so, Mr. Sherrod, I think you've done a great job on this rule, and I think you're doing a very good job in your position, which you've been in since Chairman Gensler chose you. But I just want to ask for the record, on your professional view, do you see a difference between the energy commodities, commodities of finite supply, and metals, and I might expand the question to the soft ag commodities also? Is there some reason that they should be treated differently?
Speaking just for myself and not for the staff as a whole, I think that it may be a reasonable approach to establish position limits for all physical commodities of finite supply. There may be unique characteristics of particular commodities, whether it's the storage facility or the throughput or the relative value and the ease of movement of the commodity. Some metals that are industrial have very much different characteristics than others, such as gold, that are store of value. So we would want to carefully craft a proposal that would be appropriate for those metals.
Thank you. But in general, your view is that there's no large thing that distinguishes metal where they would be in another realm. You might want to fine-tune something. You might want to have the right, a better approach or a different approach. But you view them in the same category of commodities of finite supply for which there could be a potential problem of excessive speculation which could potentially lead to manipulation, and it's something that we should consider. Is that correct?
Well,
I put too many words in your mouth?
I want to be careful to say, I think it is certainly the case that there could be excessive speculation that might be a burden.
Okay.
And that putting an outer bound in relationship to a particular market is something that I would be in favor of.
Okay, thank you. Now, I'm hopeful that the hearing that the chairman discussed in his opening comments that we will have on metals, and I don't know if it'll be on soft commodities, soft ags, but on metals in early March, I believe he said, will move us forward in the regulatory process where rulemaking could be presented much like this from the staff at that time, and you'll give us your best work as you have here. But I just want to again say I support it. I wish we could do it right now. I'm disappointed that we haven't. I do think that this hearing will also be a teaching moment too, because I think the agency, quite frankly, has done a really poor job of communicating with people over the years. I'm not blaming anybody individually here. And there's all sorts of wild accusations and conspiracy theories out there. The one that we've got hundreds of comments on in the last several days is that a particular trader, and as the chairman, Mr. Sherrod, talked about, we don't list particular traders, so whoever is suggesting it is surmising, has 40% of the silver market. That's incorrect. Right now, if you go to 2 days ago, our Commitment of Traders report shows 23%. I think that's too high. I think it should be lower. That's why I want position limits. But I want to make sure that we're not listening to everything that somebody says and just buying it hook, line, and sinker. And so I'm hopeful that this hearing that we will have will be helpful as we move forward. Now, with the chairman's indulgence, I'd like to get back to this proposal really briefly.
Absolutely, but we're also going to have other rounds. So, but
Would you rather have me defer?
No, ask a question or two, and then we'll...
Okay, Mr. Romani. Okay, thank you. So I have some of the concerns that Commissioner Dunn does, too. But I think this is a balanced proposal that actually doesn't go so far that it will send trading, it will migrate to OTC or to foreign boards of trade. Now, I don't know. I'm not a super expert on it. There's certainly the possibility, which is why I appreciate the question. But let's go back. First of all, you said, Mr. Sherrod, that this is a proposal based upon the position limit proposal that we already have, that's already used in the agriculture complex. Not on the softs that I was talking about a minute ago, but on the 9, we call them enumerated agriculture commodities. Is that correct?
We use the same general formula to establish the levels under this proposal.
Okay, so we haven't created out of whole cloth some crazy, wild-eyed, overzealous regulatory approach that's just a shocker to the system. This is something that's already used. It's been used for decades. That's the first thing. Secondly, of the traders that we have currently, if this proposal were passed today, how many traders would it impact? What's our paperwork reduction
Again,
analysis
I want to be
say?
careful to say, if it were proposed prospectively, we would estimate about 10 traders.
Okay, and in the last 2 years, how many traders would it have impacted?
There appeared from our data roughly 7 traders that don't appear that they would have qualified for any sort of exemptive relief from the limits, and 23 unique owners that had positions over the levels.
Okay. These are the largest of the large traders out there, correct? Okay.
That's correct.
So, I mean, it's a concern that, I don't want to lose their trading to less transparent markets. Absolutely. But we're talking about a system that, 1, we've used before, and 2, is very limited in scope. We have erred on the high side here, and I think that helps us with regard to avoiding any trading migration. I couldn't agree more with my colleagues. I think all of us unanimously think that Congress needs to do this OTC legislation, PDQ, and give us the authority to deal with it in an appropriate way. I absolutely have these concerns, but I don't see a reason why we can't move forward in a thoughtful and balanced approach. So I'll defer my other questions for later. Thank you.
Thank you, Commissioner Chilton. Before I turn to Commissioner Malia, Steve, I just understand, when you refer to over the last 2 years that there may have been 23 unique parties that were affected, but only 7 that appear not to be eligible for bona fide hedge exemptions and swap exemptions. I think I understood that. But I didn't understand the 10 number. Is the 10 number similar to the 23?
10 number
or
is
is the 10 number similar to the 7 or something else?
Similar to the 7. Prospectively going forward, we would prefer to err on the high side for a PRA estimate. Prospectively, if the rules were to be implemented, there may be 10 traders. Of the other 16 unique owners, because we don't actually have a bona fide hedging exemption or a swap dealer exemption request here, we couldn't be sure whether they would all, in fact, have qualified for those exemptions.
Oh, I see. So the 10 is just something for the Paperwork Reduction Act. That sometime in the future there may be, it doesn't mean, as Commissioner Chilton said, how many would be affected today, and you didn't look down the trading ledgers of last week and said, there's this many. It's sort of a prospective.
Right. What we did do is look back over the past 2 years.
I see. Okay. Sorry. Commissioner Amalia.
Thank you. In keeping and recalling that we have a limited number of traders that you believe are going to be affected by this, let me ask this question. I'm trying to reconcile the statutory obligations with the solutions provided in these regulations to determine how effective these proposed remedies will be in preventing excessive speculation. The proposal makes a case for the need for speculative limits based on the Commission's authority under 4A. The statutory requirements, the statute requires the Commission to find that limits are necessary to diminish, eliminate, or prevent the burden of excessive speculation as defined by sudden or unreasonable fluctuations or unwarranted changes in the price. After the historic price increases experienced in many of the commodities in 2007 and 2008, many described the price changes associated with that as unwarranted, sudden, or unreasonable. Yet even in the agriculture commodities where position limits were in place, they still experienced historic price changes. I understand that General Counsel Berkovitz, in his testimony, interprets the Act to say the Commission need not make a finding that these limits will work, but how can we find they are necessary to prevent unwarranted price changes if we know they have not worked in the agriculture commodities?
Well, the proposal would not address volatility in prices. Certainly, when the market fundamentals indicate that the price level should move, the price will move in a market that has fair and orderly trading. The proposal instead is designed to address any one unique owner that would have a concentrated position that may be able to distort prices and interfere with that fair and orderly price discovery process.
Still trying to reconcile then the need to deal with excessive price speculation, the issue that's specifically in the Act, and how exactly this is going to affect those prices. I understand we're not a price-setting agency, but the statute and the goals here, and I think expectations are that this will have an impact. Both Commissioner Chilton and the Chairman have pointed out this is going to affect a relatively small handful of traders, and that's what your testimony says. So I'm trying to maybe, General Counsel, you'd like to?
I would just emphasize what Steve has said, that it's to ensure that there's a balance in the market and there's sufficient diversity of traders in the market, that no particular trader can be of undue size or concentration, that particular trader's activities cause these unwarranted price changes, and therefore a price that is not reflective of the fair and orderly market. It does not prevent all volatility or all price fluctuations, and if many traders individually, many small traders acting individually trade in a particular manner, you may get price volatility from that. It's not designed to prevent the latter, only the particularly large individuals.
This proposal is a culmination of the Commission's various hearings and studies to understand the historic 2007-2008 price increases. One focus of those hearings was the role of passive investors and index traders. This proposal does not set out specific limits for either category. How do you imagine the proposed limits will impact the trading activity of this class of passive investor, assuming they comply with the limits?
As the charts I showed earlier demonstrated, two aggregators of passive investors would have historically had their ability to hold those large positions limited on the exchange.
But let me interrupt. I asked if they comply with the limits. I mean, you've got a large class of passive price-insensitive traders that are rolling these month to month. Assuming they abide by the generous limits, how does this affect anything?
The proposal doesn't address and categorize traders by a class or a group. It addresses an individual owner that would have an extraordinarily large position. So we've invited the public to provide us with input on how we might identify and define a passive index investor. It's difficult for me to try to discern what part of the market might be reserved, so to speak, for this sort of activity, and if so, how we might even allocate that space to passive investors. Instead, consistent with some of the testimony at the energy hearings, passive investors that are facing negative roll costs may decide to remove their own trading activity from the market. But the rule does not address passive investors as a class.
Let me ask one final before we go to the next round. Do you believe the Commission has adequate economic data that indicate the monthly roll of positions by passive index investors has had a specific impact on the market to create a burden on interstate commerce, or specifically has caused a sudden or unreasonable fluctuation in the price of a commodity?
Larger funds have changed the way they roll, because I think they recognized they had a liquidity demand impact if they rolled on one day. So they have in their business process decided to roll over multiple days. I'm not sure how to respond further than to say that we don't have a provision in the proposal that would address that class of investors, other than this excessive speculation because of outright size concentration of one trader.
Well, the question, and maybe we can reserve it for the economist, was does the Commission have the economic data that indicate whether there's an impact or not? There's been a lot of discussion about the potential. Both of you have raised it. I believe that we ought to look at it and make sure we know whether they have an impact or not. And I was interested in your opinion. Maybe you have data I don't have, but it appears that we don't have a smoking gun, so to speak. And just trying to make sure that we understand what that impact is. And I don't have any not opinion about it, but I do want to know whether that makes a difference or not. So thank you.
I thank you. I actually want to sort of follow up, because I think Commissioner Amalia raised important points. This approach, maybe it's more a statement than a question, but you can respond, both Dan and you. The approach that Congress took in the 1930s, asking a regulatory agency not to be a price agency. I mean, it's absolutely consistent with what the General Counsel said earlier. We don't set prices. We're not. Prices are to be established in the marketplace, and we are a market regulator, not a price. To me, why I understand that we set position limits in the past, why I am a proponent of putting this rule out for proposed comment today, is to best promote fair and orderly markets. And as I understand that from the history, that our predecessors, 5 other people sitting in similar chairs in the past, have put out things and said that this has to do with concentrated markets. Congress didn't really define excessive speculation. It hasn't been defined by the courts. It does have in statute a finding of Congress about this unwarranted movements. To me, I'm just one commissioner, but to me that has a lot to do with if a large outsized position is on the marketplace and it had to unwind that position, unwinding that position could distort a market, or even establishment of that position can distort a market prospectively. I think somewhere in General Counsel Berkowitz's comments, you quoted from the 1981 or some finding about that from our predecessors. So that's what's driving at least this one, Commissioner, not price. I'm sure there'll be some press reports that says, well, the CFTC today is addressing, et cetera, price. I don't think that's at least not this Commissioner. I think it's about concentration on markets. What did Congress mean in 1936? It's our job to sort of interpret that statute as our predecessors did, and I think to hopefully benefit from our predecessors' guidance, because they've done a lot of work here. That's sort of a statement. I don't think it's about one class of speculator either. As I understand it, it's to ensure there's a diverse number of speculators in the marketplace, and that a market would work with a greater benefit. And even the example that Commissioner Dunn raised about the U.S. Natural Gas Fund, if they move their market positions to the swap market, then there was yet somebody else, a swap dealer that may well have entered the futures market, but the futures market was more diverse. The clearinghouse risk, I think, is lowered with more diverse participants. I'm going to be very interested to see whether people agree with that. They might disagree, and we'll get a lot of proposed comments on the other side. I also think it's a question, if you agree with that, about specific concentration, what are the limits? What are the numbers? And we've built upon the model in the agriculture space. There's 10 and 2.5%, but we'll see if the public thinks there should be other numbers. So that was a long way around, but if Dan or Steve want to comment or react.
I think, Mr. Chairman, I think you've accurately put into context the proposal today in light of where the Commission has been previously, as well as congressional intent. It is not to regulate price movements. It's to ensure that no single trader has an undue size relative to the market, and there is considerable legislative history. Won't read it all out now. I'd be happy to share it at any time with anyone. But we have legislative history from the 1930s indicating that this is what Congress intended. We have the Commission's proposed rule in 1981 and the Commission's final rule in 1981, which, again, required the exchanges to impose position limits for all commodities that the Commission hadn't already set the limits. Those findings were reiterated in 1981.
Sure. I'm glad we all agree on that. I mean, the challenge this agency would have in trying to set prices, even though the word price does appear in the statute, in the reference we're talking about, I think it would be a tremendous burden and almost a futile attempt for this agency to do that. And I'm glad there's a strong agreement on that point.
I think we're a market regulator. I'm proud to be a market regulator, but that's about fair and orderly markets and making sure that the price discovery function is one that brings buyers and sellers together. Congress mandated this in the 30s, so to me it's our job to interpret it and try to implement it.
Agree. I'm also pleased to hear that picking out a specific class of investor isn't our top priority either. So,
as I understand it, it's not part of the staff recommendation. We do ask one of our 18 questions does the public think we should do that?
Correct.
And if so, how?
Yeah, and I agree that we should have the data that supports those specific trade behaviors that impact the price or impact something in the market that we ought to look at so we understand what that is. Thanks.
We've had a little colloquy. I don't know if we'll continue, but is this on my thing or?
Top of the order.
No, because. No, I just wanted to ask one question about swap dealer exemption, if I could, because I forgot to ask it later. So there's two parts of this proposed rule in my mind. There's position limits on the 4 referenced energy commodities and trying to build upon what we've done in agriculture. But then there's also bringing uniformity and some consistency to the swap exemption process. Am I right that historically we've done this more on a case-by-case basis here on agricultural products and at the exchanges, that it's individual swap dealers come in and some have an exemption that might be at this level and some might have a different exemption, more case-by-case. Is that correct?
That's correct. The exemption process that we've used for federal agricultural speculative position limits is under our bona fide hedging definition under Commission Regulation 1.3 Z3. Those are for non-enumerated cases, and we have done that on a case-by-case basis and evaluated each swap dealer's particular methodology. Our existing regulations don't provide, and the regulation is Commission Regulation 1.47. It doesn't provide a uniform application process. It doesn't provide a uniform reporting process for those swap dealers.
And so the recommendation of staff, building upon the concept release of earlier this year, in essence says let's move to a process where the swap dealers have a specific rule and they have to file annually for an exemption. and they'll all be treated the same. They'll have a new compliance standard, meaning that on any day they're over the usual speculative limit, they have to have counterparties to match up to those trades. But though they will be limited in essence to 2 times the speculative limit. Is that correct?
That's correct.
Okay. Thank you. Commissioner Dunn.
Thank you very much. And before we get into the much-awaited concept of co-integration, let me ask Mr. Sherrod, what is the notional volume of exchange vis-a-vis that of OTC and energy?
You told me you would ask a tough question, and you did. It's difficult in a particular commodity group for us to get a handle on what's an opaque over-the-counter market. We do have some data available to us that is made publicly, for example, by the OCC, the Office of the Comptroller of the Currency. But those data that are made public are aggregated. It's also inherent in that data that we don't know the extent of bank-to-bank trading within the group that's being reported, so there may be double counting. So it's a question that I really don't have a good answer to, given the opaque nature of the over-the-counter markets.
Chief economist, then.
Jeff, you want to just come up, or whomever? Or there's plenty of room. Jeff Harris, who's our chief economist, and after much very wonderful public service, I know you're going back to the University of Delaware, and we'll all miss you, but I'm glad you're still here, so you can answer these questions.
Well, thanks. I think the first week I was here, we did a hearing, so this is appropriate in one of my last weeks. I guess the question was about co-integration. We have some research in the Chief Economist's office that looks at prices along the curve. And the incentive of that paper was to look at the development of hedging opportunities at longer horizons. And the oil markets in particular over the last decade have developed some pretty substantial depth down the curve. So looking at 1, 2, and 3, now you can get on exchange traded futures now in the oil market, the crude oil in particular, out to 8 or 9 years. Those markets actually didn't exist a decade ago. So one of our research efforts was look at this concept of co-integration, which is basically just the statistical relation between any 2 sets of data series. Or you can do it up to 3, but the idea was to say, a futures contract is based on the price of oil. If I look at a 1-year oil contract that's a derivative of that oil, derivative contract being hopefully relying on the price of oil, do those 2 independent, sort of the spot price of oil and the 1-year contract, appear to be generated by the same price formation process? So we have some research out there that looking at that particular issue. And one of the surprising things we found, this is a couple years old when we found this. I guess the first draft of the paper was out more than 2 years ago. But the idea there was we found that there was this developing depth in the market out 1 and out to 2 years in the marketplace was providing better prices for hedgers, for people that wanted to come to our markets to hedge their risk out down the curve 1 or 2 years down the line. So the follow-up question to that was say, okay, well, it looks like this market is developing. There's more open interest down the curve. There's more participants down the curve. And is it related to then the diversity of the participants that participate in the 1 and 2 year contract? And how is that different now than it was, say, before 2004? The bottom line then, what we traced it to is one of the common features of those 1 and 2 year contracts that made pricing so to speak, better in the 1 and 2 year contracts for hedgers was the participant increase in the swap dealer classification. So the interpretation we made that from our office is that the swap dealers were transferring over-the-counter positions that they held on their books onto the exchange to hedge that risk. And that participation from the swap dealer, or the dramatic increase actually from 2002 up to 2005, was leading to better hedging opportunities in the 1 and 2 year contract. So in that regard, I guess it's related to the sense that the diversity of participants matters, and the swap dealers in particular appear to be bringing information from the over-the-counter trades that they do onto the exchange in the organized fashion.
You're asking good questions. That was good.
That's why you have me here. This is something I think we obviously need to do more study on, because it also looks at what the passive individuals, what type of impact they have in the long term as well. Is that correct?
Well, we do have passive traders, so we do have sort of index traders in this study that we do. The interesting part of that is they're not really a big participant group in the 1 or 2 year contract. So in the sense of the connection between the markets, the passives don't really have a role to play. As part of that study, we should say that the longer term, from the 80s on through now, short-term contracts have always been sort of related to each other. The 3-month, 6-month, and the spot price have always been well integrated or co-integrated in the statistical sense.
Does that suggest that as we look at putting on position limits, it's imperative that we understand where the over-the-counter swaps are in setting those position limits?
Well, I think one of the benefits of the proposal is that we're looking at the entire market. I think a concern we would have is if you try to isolate one particular segment or one particular contract, that might be problematic. In terms of looking down the curve, it's probably true that none of the positions in 1 or 2 year contracts would exceed these limits. So in that regard, I wouldn't think that you're pushing anybody out of the market in those particular contracts.
Thank you, Mr. Harris. I appreciate your swan song here today, and I would join the thanks of the chairman for the support that you've given me during your tenure here at the commission. Mr. Sherrard, in looking at the proposed regulation for physically delivered contracts, a spot month position limit would be fixed by the commission at 1/4 in estimated deliverable supplies for spot months class of contracts. The proposed formula is consistent with the current regulation. The proposed regulation 151.2D would require a reporting market listing physically delivered contracts to submit to the commission an estimate of deliverable supply for its contracts by December 31st of each calendar year. The commission, in setting the spot month limits, would take into consideration the estimates of deliverable supplies provided by the reporting market and would base its own determination of deliverable supplies on data submitted by reporting markets unless the commission has a basis for questioning the accuracy of the submitted data, in which case the commission could derive its own estimates of deliverable supply. This is the basic building block, if you will.
Yes.
How confident are we that the information we get is accurate?
The exchanges, in establishing their spot month limits for years, and certainly before CFMA, as Dan mentioned, would submit for prior review and approval of the commission their spot month limits. The product review staff in the Division of Market Oversight will review the exchange's submission and independently conduct interviews and assess the deliverable supplies in the commodity to verify that the exchange's estimates are reasonable.
And we've got a staff of how large doing that?
In product review and DMO, it's an activity they currently engage in whenever a contract market establishes or proposes or certifies an amendment to their spot month limits. And the head count in product review is about 15.
Do we do any consultation with other agencies such as FERC?
In particular commodities, we'll obtain information from whatever reliable sources, including Energy Information Agency or FERC, if any agency that would have reliable data. And in addition to that, we would conduct interviews with the traders that control either the storage capacity or have contracted for the throughput capacity of the particular delivery mechanism.
But we don't, in fact, have helicopters or boats going out to see if there are tankers offshore that are waiting until these limits are set before delivering the product.
No.
Begs the question, do we need them? I bring this up because I do feel that it's important, and I'm very familiar with how NAS comes up with the agriculture supply. I'm not so confident, and maybe Commissioner O'Malley could alleviate some of my concerns in this area.
I can't.
I do note that the spot month position limits, this is the limits in the last 3 days of the market, that you're proposing to do something that is consistent with what's been done last month, last year. That's the part of this rule that's really pretty much
That's correct.
consistent, energy and agriculture and so forth.
Right. The exchange currently imposes spot month position limits, and I believe our most recent review of the deliverable supplies in the major energy commodities was November of 2009.
One more question, then I'll give up the mic. I think that the DMO has done an excellent job of expanding the Commitment of Traders report and what we put out there. I think the optimal situation is that we put that report out in real time, which I don't think we have the resources to do. But I do wonder about intraday movement and ownership and control activities that take place on these markets, and how are we assured that we don't have people exceeding these position limits or proposed limits?
The Commission staff has worked to use both our large trader reporting information that gives us end-of-the-day information, as well as the time and sells, the transaction data, to marry those two together to be able to compute intraday positions of traders. In the same process of consulting with the exchanges on surveillance matters, for example, the New York Mercantile Exchange also has what they call the over-the-top program to detect intraday violations of their existing position limits.
Are a lot of those trades taking place today in the electronic market based upon algorithms?
In the data that we have, for example, in Globex, I'm not able to identify, I don't think, from the transaction data files that we have, what's the nature of the input. The Globex system data that the CME group would maintain would have that data.
Just a follow-up on that. Does DMO have the authority to request an accounting of these algorithm trading platforms as we see more and more co-location taking place? And do we understand when they're operating and when they're not operating, and what impacts they're having on the marketplace when they are in operation?
Well, both the exchange surveillance staff and the Commission surveillance staff will observe prices and transactions to try and detect any abusive trading patterns or any violations of the position limits. And we do have, for example, special call authority that we can use on anyone that's accessing the regulated markets.
Well, this proposal is being billed as a prophylactic measure to ensure that there's not a disruption of the marketplace. And I would submit that I feel that there's as a greatest potential for disruption vis-a-vis this. And I'm wondering if that isn't a good idea for us to begin on a routine basis asking for and assessing those programs that are being used and whether or not they hedge or butt up against a violation.
And just so I can understand, Commissioner Dunn, you're referring to the intraday movements and particularly how they might relate to algorithmic or high-frequency traders. I mean, not isolated to them, but that's the intersection. All right.
I agree, and we have been looking at, through our own intraday surveillance, detecting and referring to the Division of Enforcement those positions that do violate intraday, the speculative position limits.
And as I understand it also, this is really recently, but we've been working with the exchanges, NYMEX you referred to, but also in the financial and agriculture, the rest of the exchanges, to ensure that they have automated surveillance, which has these, it's called alerts. The computer can flag an alert in the middle of the day as well. Is that right?
That's correct, but we do intend to make continuing enhancements in the automated nature of how we detect and then deter this type of activity.
Great. Should I switch to Commissioner Summers, and then if you have others and your voice comes back? Commissioner Summers.
Actually, just to follow up on this same line of questioning in the intraday surveillance, and maybe Dan would be able to answer this as well. If we are given the information from the over-the-top system that there are violations intraday of these position limits, what happens? How do we enforce that? What are these people fined? Are they, what then do we do? These are all intraday violations that I would guess that we are getting then that information that you talked about from the over-the-top.
Right, and that happens to be probably a trade secret name of the CME group, so I probably shouldn't have said that. Typically, when a trader is detected exceeding a limit, there might be reasons for that. And under our existing agricultural federal speculative position limits, for example, a trader can have a self-executing exemption for bona fide positions related to their cash market positions. And because that process is self-executing, then the typical first step is an inquiry with the trader as to the nature of why their position has exceeded a limit, because it may be one of these self-executing exemptions. The trader also may have simply had an increase in their anticipatory hedging need and kind of neglected to file the supplemental statement that would document and justify that increase. But that is the first step, is to inquire with the trader, and it's the usual first step in surveillance to ask the trader what their intentions are, and that usually resolves the limit violations. We would, as a regular course, provide a letter to the trader identifying that we've identified them as over an applicable limit, and we would copy internally our Division of Enforcement.
If the example that was given earlier is that it is a high-frequency trader that I think probably would not be subject to those sorts of exemptions, then the letter would go forward and we would have some sort of enforcement action against them.
Absolutely. DML's role is to inform our enforcement division and let them proceed.
Thank you. I would like to say that I share Commissioner Dunn's, the concerns that he's articulated with regard to the OTC markets and us not having the jurisdiction over those markets, and potentially that the chart that's up on the screen now shows an ETF that has gone over, and that when we told them to get their position under a certain level on our markets, they went OTC. So it leads me to a question about how, or if we have contemplated, if we do get jurisdiction over the OTC market, how would this proposal go into effect? Would we use the same sort of formula that we have used in this proposal and just add in that market? Would we have to go back out with another proposal that would apply to that market separately? You know, how do we contemplate having this be an umbrella proposal over the entire market?
Well, the current proposal would not extend automatically in scope to the OTC market. It would require a subsequent notice of proposed rulemaking. As we understand it, in the OTC market, a swap dealer may have a number of substantially related commodities that they, in the aggregate, bring the net hedging need to the regulated market. So I think we would have to think carefully and thoughtfully about how to appropriately aggregate the OTC positions that would be price fluctuations of the OTC contracts would be substantially related, but not be in the same reference energy commodity. So the proposal we have today, we would have to do some work on to extend it.
Thank you.
Thank you, Commissioner Summers. Commissioner Chilton.
Thanks. Just real quick, Mr. Berkovitz, I want to get back to just one quick question on metals. I made this comment about what I thought people maybe thought we were staff-driven at times, and Mr. Sherrod sort of, I hope, allayed anybody's fears out there. I mean, ultimately, it's these 5 votes who make a determination, and but we do take your advice. But you are relatively new to the commission last year when the chairman stole you from Senator Levin's staff, where you worked on speculation legislation. I want to know if you have any opinions that might be divergent from Mr. Sherrod with regard to why metals should they be treated different than, for example, energy contracts, or do you see the similarities like Mr. Sherrod does?
No, I think I would agree with Mr. Sherrod's comments. The premise that commodities of finite supply are subject to the potential for excessive speculation or price manipulation set forth in the Act in a very general manner. I can't personally see any reason why any particular class of commodities should be excluded from those general principles. Agreeing with what Steve said again, each commodity has its own very particular circumstances, so one has to look closely before proceeding to implement that.
Great. Thank you for that. Back to the issue at hand. Look, these markets have changed. They're different than they were. I'm not saying that that's a bad thing. It's added to the economic engine of our democracy. The futures industry in the U.S. Increased 5 times when around the world it increased twice in a 5-year period. That's not a bad thing. But these are new market participants, and there's different dynamics. And our role as regulators is to simply try and figure out if we are upholding our responsibilities that were entrusted under the Commodity Exchange Act to prevent and deter possible fraud, abuse, or manipulation. So, the question is, well, how do you determine if you should do something? And so you look to the experts, you look to economists, and to be quite frank, there's economists on both sides of this. Mr. Hyland's with us today. He disagrees with the studies I tend to agree with. Rice, Princeton, MIT. There's one out this week from Lincoln University in Missouri. So, you have them on both sides, and people can pick them apart. But the fact that it is a hypothetical possibility that these new dynamics in the futures industry could have an uneconomic impact on prices. When I say uneconomic impact, I mean something that is devoid from supply and demand fundamentals, that it can have an uneconomic price impact. And let's not forget, these markets have an impact on everything from bread to gasoline to home mortgages. So it's a big damn deal for consumers. It's our job to prevent that. So, for me, if there's the possibility, we need to figure out a way to deal with it, but not so in some crazy way. Not so in a way that does the things that we've talked about, like migrating markets. And that's why I think this proposal strikes a really good balance. 9 months ago, I would have said these position limits that we're talking about now should be much more stringent. But I think because of the environment that we're in, that we don't have the regulatory reform in Congress yet, I think it strikes the right balance. And Mr. Sherrod, I want to go specifically to exemptions. I think you've done a good job in this regard. One, we've targeted the exemptions in that we've separated the bona fide hedgers, those that have an underlying interest in the physical commodity, from the swap dealers. So you've targeted them. Secondly, we are going to approve them ourselves, the swaps dealers. So no longer will the exchanges, and they've had a good run. They approve these exemptions. We will approve them. And I'd like you to talk in just a minute about that specifically, the process for going through that. Third, we will verify these exemptions. We will, Bruce Springsteen's going to prove it all night. They're going to have to prove it all the time that they need these exemptions. And fourth, and this is really critical, is that it's open and transparent. Again, right now you ask us, we can't tell you who has the exemptions or how many there are. If anybody thinks there's a conspiracy theory, that's evidence in their mind that it does. And it's not the truth going forward, I hope. So could you explain how we are going to make the determinations about these exemptions and what the verification process is going to be? And lastly, some would be concerned that, for example, a large swaps dealer might go out. One of them, for example, has a large natural gas business in the Northeast. But that's not their primary business. But can they go to the exchange and seek the bona fide hedge exemption, the commercial exemption, when in fact their main deal is their bankers? So I've given you a lot to answer, but it all has to do with those exemptions, please.
The process for a swap dealer is, as you said, the swap dealer would apply to us with an initial statement. They would represent themselves as a swap dealer, as it's defined in the regulation, and provide us with their current net risk management needs, and that is the amount of futures contracts that they would need to offset the risks of swaps they've entered into with their customers. So their client...
And not for their own book. This is not for the swaps dealers to go out and speculate and make money on their own book. This is only for their legitimate business of their customers, a hedge against their customers' positions. Is that correct?
That's correct. So that they would not present to us their proprietary swaps that they've entered into for speculative purposes through their proprietary trading desks. They would then file a monthly report. It would be a new Form 404, and that report would identify on a day-by-day basis their net risk management needs. At any time that they were increasing the amount of their net risk management needs from the prior highest level, they would tell us that on a next business day basis. The proposed regulation would also require that the swap dealer maintain books and records that documents the details of those counterparty swaps so that we could verify the size, the notional amounts, and that these were customer swaps.
So let me just interrupt and make sure that we're clear on that point. So, for example, if I'm a trader and I have reached, under this proposal, I've reached the limit, and I say, geez, I really want to have more of that, but I can't get them myself, so I'm going to go to a swaps dealer. Is that a workaround for them, for those traders to abrogate the position limits, or is there a responsibility on the part of the swaps dealers, those that have the exemption, to know who they're doing business with? How does that work? Or how would it work?
Because we don't have current authority to aggregate the OTC positions with the regulated markets, then it would not be a responsibility of the swap dealer to...
But what if the positions of their customer is on a regulated exchange? So Trader X has reached their maximum percentage on NYMEX. Now they say, I want more. I'm not talking about the OTC. So they go to a swaps dealer and they say, buy me another 20,000 contracts, which would in essence get them, they would abrogate the position limits. How do we guard against that?
And you've identified exactly why the Commission staff have recommended, and the Commission's gone to Congress to try to expand our authority. The swap dealer would not necessarily know the position of that customer on the regulated market. And we, as we've explained, are by statute not able to disclose to the swap dealer the regulated market position of their customer. So the swap dealer is not in that position to impose an aggregate limit across the OTC swaps they have with that particular swap dealer, maybe swaps with other swap dealers, as well as the customer's position on the regulated market. So that still remains a distinct possibility that a trader could attempt to continue to gain exposure to an energy, a reference energy commodity, by engaging in OTC swap transactions.
Now, would we be able to see the swaps dealers' customers?
We would only be able to see a swaps dealer's customers, the books and records, in the event the swap dealer was availing themselves of a swap dealer exemption.
Okay.
In the normal course of business, our expectations are that few swap dealers would need to make application to the Commission to avail themselves of that exemption.
But if they have an exemption, and we want to look, and we're going to have rigorous reporting and record keeping. They have this exemption. If we want to look to see who their clients are, we'll know the positions on the regulated exchanges, and so we could tell if somebody was trying to use an end run to abrogate the position limits. Is that correct? We could find out, at least theoretically.
At least theoretically, we could find out to the extent the person attempting to circumvent the limits went to a swap dealer and drove that swap dealer so far out of balance that the swap dealer needed to avail themselves of an exemption.
Okay. Okay, that's good for now. Thank you, Mr. Chairman.
I'm going to turn it to Commissioner Malia, but I just would have helped. I like staffing you, Steve. On a Q&A that we actually will have on our website, I think we already have this maybe on our website. I should say to the public listening, we have both the General Counsel's remarks and Steve Sherrod's remarks and all these graphs and a Q&A on our website. But on a Q&A on an earlier question, it said, how many traders would the CFTC proposal affect? And says the notice of proposed rulemaking, if finalized, would have affected, meaning past tense, would have affected approximately 10 large traders across the 4 reference commodities. So I don't know whether it's just a coincidence. It may be a coincidence that it would prospectively affect 10, but I think in my office a week ago you actually showed me a list of 10 people that it might have affected 2 weeks ago. So it may be a coincidence that it's both that it would currently affect 10 and prospectively affect a different 10. Or it's a typo. But I just wanted to help you.
Point of clarification, is that with or without exemptions that they may have?
This was without exemptions. This question, it's a coincidence, but in the Q&A, this was 10 traders. I believed from the briefing you gave me a week ago that it was 10 traders before exemptions. Do you help to clarify?
That's correct. It's before exemptions, and we may well have intended to make that prospective and used a past tense, but we did not identify what day that would have been.
But is it accurate, and please, none of us will go past what we can disclose publicly, but that as of some couple of weeks ago when you looked at it, on one particular day it was approximately 10, some of whom could have a bona fide hedge need, some of whom could have a swap need? Or maybe I just remember it wrong.
We've been discussing with the different commissioners' offices 2 years' worth of sampled data and intensely sampling different time periods more than others. So it might be any time period over the last 2 years.
You mean that you might have just shared with me one time period?
Right.
Thank you. I didn't mean to, but it's because it's on our website. So, Commissioner Amalia.
Thank you. First, I'd like to associate myself with comments by Commissioner Dunn and Summers regarding the posing limits when we don't have OTC authority at this point and the potential impact that could have. And I've had this chart of the natural gas fund staring me in the face. Let me ask, do you believe that we're looking out for the best interest of the consumer, the actual individuals, pension plans, and others who have invested in this fund by taking on, who have taken on additional risk and costs as a result of shifting to OTC markets, which we, of course, don't have authority over?
I don't know the particular credit arrangements in the OTC market that the fund has entered into. It is true that if the limit would have been in effect, they would have had to reduce their positions on our regulated markets, and they might have responded at that time by entering into OTC transactions. But there are certainly behind the basic concept behind the proposal is to address a concentration by any one party, any one owner, that would be large relative to other speculators. And this particular fund's position in a single month has been large relative to other speculators.
Let me build on the concerns of Commissioner Chilton. I know the chairman has this concern as well. In this bona fide hedge exemption, the look-through issue, and Commissioner Chilton was getting at this, and I'm a little unclear about what we would get with the 2 times, under the 2-time limits in this proposal, and my desire to see if there's an opportunity to look on a more consistent basis as opposed to just when they trigger the 2 times limit. I understand there was some testimony during the hearings on position limits and potentially during this debate on the hedge exemptions that you would offer a limited hedge exemption. You could offer a limited hedge exemption to swap dealers in exchange for, look through on that book, and to see on a more consistent or day-to-day basis who's behind the trades and what positions they have. Obviously, that seems attractive. If we don't have authority over the OTC markets right now, that would be an opportunity to take a better look at what's behind that activity and have a better understanding of the market. Walk through why the 2 times limit and why not the other.
The primary purpose of obtaining the books and records is to demonstrate that they have a legitimate risk management need, that their swap book of customer business is out of balance, and that it's not related to their own proprietary trading. If, for example, we were to see a dramatic change in a swap dealer's risk management needs, then we might inquire further to that base of customer transaction to see what in their activity drove them to be that far out of balance. But the primary purpose is not to look through to the nature of their customer business. In looking through to see the names of the customers, we would not be able to identify whether that particular counterparty in the swap transaction had entered into that to offset a bona fide risk, a commercial risk of the company, or whether in fact the company was speculating. Many large companies enter into swap agreements either to speculate or to manage their risks or to hedge. They do not need to reveal that confidential business information to the swap dealer to enter into that transaction. So our information would be limited to the name of the counterparty to the swap and the notional size and what the particular commodity that's referenced in the swap agreement was.
Obviously, if we change the rules, and as this proposal would do fairly significantly, we might be able to ask that question of the swap dealer in exchange for providing them a bona fide hedge related to hedging that book versus a 2 times limit.
I think the difficulty with extending further requirements onto the activities of that swap dealer into the OTC market might be better addressed in a global context as opposed to in a hedge exemption context. So some of the initiatives that are on the Hill to establish swap repositories and uniform reporting requirements might more directly address the scope of the activities. As I was talking with with Commissioner Chilton, someone could attempt to evade the limits by engaging in multiple small swap transactions with multiple dealers. And any of those small transactions may not, in fact, drive any of those swap dealers to need to avail themselves of the swap exemption. So certainly an increased level of transparency, at least to the regulators, would be helpful. I don't think this is the appropriate mechanism to get that increased level of transparency.
Let me ask one final question. In setting the limits on open interest, the rule provides for an annual reset. I think we have a question in there about a rolling reset, and we'll be interested to get the comments on that, but would that benefit or give us a more accurate picture of where the markets are, or at least providing better trading data to the market itself?
I think the idea of an administrative procedure to automatically, in a regular interval, update the levels, the speculative position limits as the market's open interest grows or declines has a lot of appeal. Whether an annual update is the appropriate interval is the subject of our question. Certainly, I think traders can benefit, whether they're trading for speculative or commercial risk management purposes, from some degree of consistency, and we thought a 1-year time period would allow a reasonable response to changes in the level of open interest, and provide that level of consistency so people would know what the rules were in advance.
Thank you, Commissioner Amalia. I don't have any further questions. I don't know. We've had a pretty full debate here. Commissioner Chilton?
Nobody? Okay. Mr. Sherrod or Mr. Berkovitz, agility on these limits. So say we set them exactly this formula, and say at some time certain they're implemented. And then something happens where we decide we need to change them. Maybe we further calibrate. Maybe we need to ratchet down. Maybe we need to increase them. Maybe we get the OTC authority and we need to increase them for some reason. What's the mechanism for that? Is it an entire
making proposal? And if it is, you're shaking your head, it might be rulemaking. If it is an entire rulemaking proposal, is it possible for us to act expeditiously without invoking an emergency order by doing like an interim final rule where we would just put it out and have it take effect immediately?
Well, I'll speak as not as the General Counsel as he's consulting. But yes, the mechanism to update the formula that we would apply, we would envision that would be a rulemaking. There are exigent circumstances so that we could adopt an interim final rule, and I'll defer to the General Counsel.
That's right. We could do interim final rule. We could use emergency authority. We have exemptive authority under particular circumstances that we could use.
Okay. And another issue in here that I didn't, I think maybe Commissioner O'Malley mentioned it, but I want to highlight it. It's another one of these questions. We asked the metals question, we asked a question on softs, and we asked a question about this class of investors that I call massive passives, for lack of what I'm sure is a better term for other people. But essentially folks that have predominantly, not always, but predominantly a long strategy, a long passive strategy. We talked about this a lot last week when we were talking about the cotton report and how 41%, 38 to 41% during these troubled, volatile cotton market times in 2008, there was 38 to 41% of these massive passives. So we asked the question on whether or not they should be limited individually or in the aggregate. And I think it's a good question. Like metals, like the ags, we couldn't do anything now. It would be a separate rulemaking on addressing them. I just need a yes or no from one of you on that. Yes. Okay, thank you. And to be honest, I haven't figured out how you would do it anyway. So if some enterprising people want to come up with an idea, I'm certainly interested in it. I don't know how you would implement such a proposal. But I put that out there as make sure that people know that is a question we're interested, at least this commissioner is interested in. Mr. Sherrod, would you tell people how they comment? What is the procedure for them commenting? Can they do it online? Do they mail it to our secretariat, Mr. Staywick?
Absolutely. Comments can be submitted by letter to the CFTC secretary. They could send it by facsimile. We still actually have facsimile at 202-418-5521, or by email to the secretary, and his email address is secretary@cftc.gov.
Okay. And what is these comments? And I think there will be a plethora of them. Will they be published? Can everybody see these comments, or is there something nefarious and sneaky, or these are going to be out in the open, right? Everybody's going to see every single comment
if they
want to.
Absolutely. It's the practice of the Commission Secretary to post comment files to notices of proposed rulemakings on our website at www.cftc.gov.
Okay, and that's for a period of 90 days, and it's not 90 days from today. It's 90 days from when this rule is actually makes it to the government printing office and it's put into the Federal Register. It's the clock starts on that day and it goes for 90 days. So for people that are wanting to comment on this rule, they can do it through those various means, and they have 90 days from today. They'd be safe 90 days from today, but 90 days from when it gets published in the Federal Register. Is that correct?
That's correct.
Okay. I don't have anything else, Mr. Chairman.
I thank you. If there are no other further questions, I think it would be helpful. General Counsel, you didn't know this question was coming. Can you just not only advise the 5 commissioners but the public as to, once a rule like this is public, about ex parte conversations? There will probably be numerous people that will want to come into any one of our 5 offices and say something about this rule, and just so that we are doing the right thing under the Administrative Procedures Act.
The Administrative Procedure Act requires the Commission to base its decision on a final rule on the public record. It's been the Commission practice with respect to communications on the rule. Obviously, there's the public comment period. People can come and talk with the agency, but it is the agency's practice, and it would be the agency's practice to make a public note of the meetings, to have a note as to who met, the date, a brief summary of the meeting, and also publicly post any documents that were provided to the agency during such a meeting, so that all the comments are publicly available.
But once we're in a deliberative process, everything would be public and posted.
Correct.
The main thing.
Mr. Chairman, I had a quick logistical thing also. Assuming that this was, which I know it's not, the perfect proposal, and everybody said yes, and 90 days elapsed, what would be the time frame under which it could go forward with regard to the staff's view? Now, as I said earlier, none of this happens unless there are 3 of the 5 of us. So nothing happens automatically. We're looking at the comments. But is this something that staff would need to spend months and months on? Is it something that we're going to have in place before the summer driving season? Is it something that's going to take years? Can you give us some idea, Mr. Sherrod?
Well, I think we would want to carefully consider all the comments of the public. And because these rules might raise a significant amount of comments from the public, it will be part and parcel of the depth of those comments and trying to respond in a draft preamble to all of those comments to say how we took into consideration the public's views. We'll certainly have a group of staff reviewing the public comments as they come in to be as expedient as we can.
So that's not 2 years, but it's not 2 weeks. Is that the time window you're given, Ms.?
I think it's safe to say it's not 2 weeks.
Okay. But it's not 2
There
years.
are no further questions.
I hope it's sooner rather than later.
I would note that I think we got thousands, not hundreds, but thousands of comments after our hearing when we kept the record open. I don't recall the final number because we just kept it open, but it was measured in the thousands. If there are no further questions, I would like to invite my colleagues to provide any closing remarks. And in this case, I am going to go as the youngest first, youngest in terms of commission. Well, no, the youngest would be always here, but Commissioner Amalia.
Thank you. Mr. Chairman, before I begin, I'd like to acknowledge all the Commission staff who've worked long hours and through the holidays to develop this proposal. I'd like to thank Steve Sherrod, Bruce Faircat, and Dan Berkovitz in their willingness to provide briefings to me and my staff. With 4 commissioners and a chairman making suggestions and revisions, they have shown an amazing amount of patience and professionalism, and I thank you for that. I appreciate your willingness, Mr. Chairman, to hold this meeting and appreciate the support of the full Commission. This rulemaking is extraordinarily complex and warrants careful consideration. I support the release of this draft rulemaking in order to take comment on a policy option that has been widely discussed since the commodity price spikes in 2007 and 2008. I encourage our market participants to inform the Commission about the impact of the proposed limits or potentially lower limits as a result of this rulemaking. While I support the release of this draft, I have many concerns regarding the proposal's effectiveness and justification. Keeping in mind the importance of maintaining the market's fundamental purpose of allowing customers to hedge commercial risk, I question the utility of rules that either present any potential for circumventing CFTC authority or making markets less transparent or liquid. I question the effectiveness of these regulatory changes, especially as Congress is considering a much broader and comprehensive financial reform package. I remain particularly concerned with the impact of enacting the proposed position limits on the regulated exchanges while the Commission lacks regulatory authority to impose limits on all similar energy transactions, including the OTC markets. As we work to increase transparency in these markets, the proposed limits may undermine our efforts by allowing participants to turn to the less regulated and less transparent markets, which would be a detriment to both markets and the public. Earlier this year, the Commission held hearings and heard testimony from witnesses frustrated with recent price and volatility in the commodity markets. Some advocated that the Commission immediately impose position limits as a solution. This created a high expectation that any Commission proposal would have limitations on passive index and speculative investors, which have been blamed for commodity prices. The release states that no more than 10 trading entities would be affected, and most of those would be entitled to a bona fide hedge exemption. This means that few, if any, passive index and speculative investors will be significantly impacted by the proposed limits. The Commission would benefit from learning the impact, if any, the proposed limits would have on the trading strategies of passive investors going forward. In addition, I believe the Commission should endeavor to improve the understanding of the impacts of passive investors rolling over their position on a monthly basis to determine if that may have an impact. The proposal makes a case for the statutory justification for the CFTC to impose position limits under 4A of the Act. However, the proposal fails to make a compelling argument that the proposed limits, which only target large concentrated positions, would dampen price distortions or curb excessive speculation. In large part, the lack of compelling justification may be due to the fact that the CFTC's own research and the Interagency Task Force on Commodity Markets conclusion that the rise in oil prices was largely attributed to fundamental supply and demand factors, which is supported by independent analysis. In addition, the fact that proposed position limits are modeled on the ag limits forces us to examine whether those limits were effective in preventing the price spikes in 2007 and 2008. Despite federal position limits, contracts such as wheat, corn, soybeans, and cotton were not spared record-setting price increases. The proposed limits provide swap dealers with twice the single and all months combined level. This is a divergence from the current practice of providing dealers with a hedge exemption for commercial risk taken on OTC transactions. I question whether the Commission has missed an opportunity to consider an alternative approach to collect data that it currently doesn't receive on trading activities in both regulated and non-regulated markets as a condition of providing the dealers a limited exemption. The rule seems to provide a new record-keeping requirement, but not a full look-through to determine the trading position of each customer. I would be interested to receive comments as to whether or not the Commission should impose new record-keeping requirements with a 2x limit on swap dealers, or an alternative that would preserve the current hedge exemption in exchange for greater transparency of OTC market positions. If position limits are implemented, the Commission must ensure that such limits do not affect market liquidity and thus hinder the fundamental purpose of allowing hedgers to manage their risk. In light of the many questions and concerns I have, I look forward to receiving the comments from those with interest in the markets and who would be impacted by the proposed limits. Finally, I'm pleased that the Commission will have a hearing on the metals markets that will address conditions and whether the limits are warranted in these markets. Mr. Chairman, I intend to vote yes for the release of the proposal, and that I have a concurrent statement to be included in the Federal Register.
I thank you, Commissioner Malia. I think all of our closing statements actually will be, so I just want to make sure. I think that's what I understand from our General Counsel and from our Secretariat. So all of these closing statements will be in the Federal Register, unless there's yet a statement beyond that.
Well, I have a shorter, more concise statement without all the flowery stuff that I would ask to be included.
You don't want the public to see the flowery stuff, Scott?
I'd love that.
Right.
I'd love both.
All right.
Newbie.
Yeah. But I think all 5 of these closing statements will be in the Federal Register. Commissioner Chilton.
I won't give my statement. It will be included in the record. I think, if anything, I think I've been clear on where I am. I think this is a good proposal. I thank the staff for doing it. I am disappointed metals isn't in it, but I hope we can move forward with this hearing, and I hope we move forward on not only putting this out and looking at the comments, but on implementing it at some point in the not-too-distant future. Thank you, Mr. Chairman.
Thank you, and your full statement will go in. Commissioner Summers.
Thank you, Mr. Chairman. I want to thank you for scheduling this important hearing or meeting. I know it's quite rare for this agency to have this kind of discussion or public meeting to discuss a proposal like we're doing today, but this particular rule, I think, deserved an exception, and I think this meeting has been very helpful to me and hopefully to the public that has been so interested in this issue. And I hope this is just the beginning of this type of open dialogue here at the CFTC. The Commission and its predecessors have grappled with the complex issues surrounding federal speculative position limits for many years in connection with transactions based on agricultural commodities. As prices rose across the board in virtually all commodities throughout 2007 and 2008, the Commission focused its attention on possible causes, including the influx of new traders into the markets, in particular swap dealers hedging the risk resulting from over-the-counter business and traders seeking exposure to commodities as an asset class through passive long-term investment in exchange-traded funds and commodity index funds. Concerns were raised in both congressional hearings that excessive speculation in both exchange-traded and OTC markets was to blame for the rising prices, particularly in the energy sector. The Commission held 3 days of hearings in July and August of 2009 to discuss a number of different approaches, and we've received continuous feedback from the industry for the past several months. We now have before us a proposal from staff which would implement federal speculative position limits for futures and options contracts in certain energy commodities. I dissent from issuing the proposal for the following reasons. I'm concerned that hard position limits may be imposed on exchange trading without similar limits in place for the OTC markets. Legislation giving us the authority to impose OTC limits may be enacted this year, but timing and the final form of such legislation is unknown. While I wholeheartedly support efforts to enhance our authority in this area, I'm concerned that forging ahead with federal limits in a piecemeal fashion is unwise. I'm especially concerned that doing so will have the perverse effect of driving portions of the market away from centralized trading and clearing at the very time we are urging all standardized OTC activity to be traded on exchange or cleared. Likewise, I'm concerned that without global standards, trading will move to other financial centers around the world. A report issued by the UK's FSA and HM Treasury last month urges caution in introducing a position limit regime. Clearly, more work is needed to achieve a uniform global approach. A delay in promulgating position limits will not leave the markets unprotected. The proposal before us sets high position levels that are at the outer bounds of the largest positions held by market participants. Exchange position limits and accountability rules remain in place and will continue to trigger the first line of defense against potential market manipulations or other disruptions. Even if the proposed federal limits were enacted, exchanges would be obligated to begin monitoring positions on their markets well before traders reach the federal limits. Aggressive use of the Commission's surveillance authority in partnership with the exchanges should be sufficient to closely monitor and protect the integrity of the markets. Finally, the proposal makes no distinction between passive ETF and index traders and speculators. While the proposal does seek comment on the feasibility of categorizing such traders differently, I am discouraged that we are no closer to an answer than we were prior to our 2009 hearings, the numerous congressional hearings that were focused on index trading, and the Commission's extensive collection of index investment data since 2008, which it now publishes on a quarterly basis. There is no doubt that passive, long-only investors do not behave as typical speculative traders. They have a unique footprint in our markets. If the data demonstrates that passive long traders are disrupting the markets through the rolling of their positions or otherwise, the Commission should make an affirmative finding and tailor a solution that addresses this problem. It is also my hope that if the Commission adopts the limits included in this proposal, that it also promulgate federal limits for all other commodities with a finite supply, such as metals and agricultural commodities not currently subject to federal limits. The rationale given for the current proposal applies equally to contracts in those commodities. Another inconsistency that would result if the Commission adopts the proposed rulemaking is that swap dealers would continue to receive bona fide hedge exemptions for positions related to agricultural commodities subject to federal limits, but the new proposed risk management exemption regime would only apply to positions related to the 4 energy commodities included in this proposal. A uniform policy would benefit not only the Commission and market participants from an operational efficiency standpoint, but would also enhance transparency by eliminating needless complexities in the process. I want to close by thanking the CFTC staff for their tireless efforts over the past almost 6 months. This has been an enormous undertaking for us, and we have quite a long road ahead. As we endeavor to address the individual concerns of both commissioners and the market participants that publicly comment over the next several months, I want to let you know how much your time and talents have been appreciated to this Commission. Thank you.
Thank you, Commissioner Summers. Commissioner Dunn.
Let me also join the chorus of thanks to the staff in this particular process. I think it is demonstrative of this Commission, CFTC, I guess we can call it the Ginzer regime.
Now.
And trying to get as much information as we can on this as we act. But today, I am voting to release the proposed notice to rulemaking entitled Federal Speculative Position Limits for Referenced Energy Contracts and Associated Regulations. My vote to release this proposed rule should in no way be construed as an agreement with the opinions expressed in the proposal or the approach advocated in setting these proposed position limits. Despite my serious reservations, I have agreed to release the proposal so that the public at large has ample opportunity to voice their opinions and concerns on this topic. At the close of the Commission's position limits hearing on August 5th of 2009, I stated that the CFTC does not have the authority to set speculative position limits in all of the venues that may be affected by excessive speculation, specifically over-the-counter markets and foreign boards of trade. Unilateral Commission action in only the markets we currently regulate may not have the desired effect of reining in excessive speculations in the futures market. Without similar steps in the over-the-counter markets and the foreign boards of trades, those seeking to evade the limits we set could simply move to venues outside of our authority. I believe this is still true today, and that forging ahead on position limits regime for political expediencies is not the course of action that this agency needs, or one that promotes the health and integrity of the futures industry of the United States. The simple announcement of our hearing several months ago has caused businesses to migrate to over-the-counter markets and foreign boards of trade currently outside of our purview. This is an unacceptable consequences of regulation and is, I fear, a sign of things to come if this agency does not take a coordinated approach in bringing sensible regulations to the futures market. I think it needs to be made clear that the proposed position limits do not set trading limitations on any particular class of investors, including passively managed long-only index funds. The proposed position limits' sole object is to prevent excessive speculation by a single entity. I would be very interested to hear from the public on whether this incremental approach best addresses the market-wide concerns raised by those who have been participating in our hearings process. I would like to reiterate that my vote to release this document should in no way be construed as an agreement of any kind to final rules setting federal speculative position limits on energy contracts. My commitment remains to accept comments and information during the next few months with an open mind and to work with my fellow commissioners to ensure that we have a functioning futures industry.
Thank you, Commissioner Dunn. Thank you all for my fellow commissioners. I'd also want to once again thank Mr. Berkovitz, Mr. Sherrod, Mr. Harris for the swan song, and all members of the staff for the thorough and well-researched recommendation and all the hard work that has gone into this and a very thoughtful and transparent presentation. Today's meeting will conclude with the Commission's first public vote on one of its rules, actually in 8 years. And I look forward to additional public meetings as Commissioner Summers and actually Commissioner Dunn, Chilton, and O'Malley all have commented on. The CFTC is charged with a significant responsibility to ensure fair, open, and efficient functioning of futures markets. Our duty is to protect both market participants and the American public from fraud, manipulation, and other abuses. And central to these responsibilities is our duty to protect the public from the undue burdens of excessive speculation that may arise, including those from concentration in the marketplace. Now, the CFTC does not set or regulate prices. Rather, the Commission is directed to ensure that commodities markets are fair and orderly. It is for that reason that I support the staff's recommendation on the rulemaking regarding position limits in the energy markets and exemptions for swap dealer risk management transactions. The CFTC is directed by its original 1936 statute to set position limits to protect against the burdens of excessive speculation, including those caused by large concentrated positions. In that law, the Commodities and Exchange Act, Congress said that the CFTC shall, I repeat, S-H-A-L-L, shall impose limits on trading and positions as necessary to eliminate, diminish, or prevent the undue burdens that may come as a result of excessive speculation. A transparent and consistent playing field for all physical commodity futures, I believe, should be the foundation of our regulations. and thus position limits should be applied consistently to all markets and trading platforms, and I believe exemptions to them should be consistent and well-defined. And that is also a reason why I so look forward to our future hearings in the metals markets. While we are currently set and enforce position limits in certain agricultural products, has been discussed, we do not in the energy markets for these last 8 years, or nearly 9 years. When the CFTC set position limits in the past, the agency sought to ensure that the markets were made up of a broad group of market participants with a diversity of views. At the core of our obligations is promoting market integrity, which the agency historically interpreted to include ensuring the markets did not become too concentrated. And position limits help to protect the markets both in times of clear skies and when there is a storm on the horizon. It was in 1981 that this commission said that, quote, the capacity of any contract market to absorb the establishment and liquidation of large speculative positions in an orderly manner is related to the relative size of such positions, i.e. the capacity of the market is not unlimited. I think that's still true today. So the futures market also has an obligation with regard to the setting of position limits. I said the futures exchanges. As was explored in our summer hearing and as General Counsel Berkovitz discussed today, the Commodity Futures Modernization Act changed the exchange's obligations. They have to comply with a core principle, I think it's core principle 5, that speaks to providing against manipulation and congestion, quote, especially during trading in the delivery month. These core principles do not, though, explicitly require the exchanges to set position limits to guard against the burdens of excessive speculation. The Commodities and Exchange Act in Section 4A left that obligation to the CFTC, and they left it unchanged with regard to setting position limits to guard against the burdens of excessive speculation. So we as a commission, I believe, should comply and need to comply with our statute. We were left with this obligation. The exchanges have a different and distinct obligation. Our governing statute importantly distinguishes between two distinct but very related public goals: protecting against manipulation and protecting against the possible burdens of excessive speculation. And of course that's what this whole hearing has been about and what we're grappling with. The Commodity Futures Modernization Act clearly established that the exchanges had to address the first, manipulation and congestion, in the delivery month, while the CFTC had a broader mandate to address both, manipulation on the one hand, but also this concept of the burden of excessive speculation. And though the CFTC had in 1992 first allowed exchanges to establish accountability levels, it was only in 2001 that they actually did so in lieu of position limits in the energy markets after the passing of the CFMA. So the past 8 years have provided further evidence as to some of the distinction and difference between these two regimes. Accountability levels are regularly and repeatedly exceeded. In fact, they are neither hard stop signs or even yield signs for market participants. As reviewed in our summer hearings, the 12 months through July 2008 to June 2009, these accountability levels in individual months were exceeded by 69 unique traders, some actually exceeding them on every single trading day of the year. The staff recommendation, I believe, builds upon the experience and previous guidance of setting position limits, particularly for agricultural commodities. And I believe it is done in a measured and balanced approach in setting position limits in the energy markets. In addition to resetting position limits in the energy futures markets, it also addresses a very important matter with regard to bona fide hedgers and establishing a consistent framework for certain swap dealers and the risk management exemptions. The Commission and the exchanges currently grant this relief to swap dealers on a case-by-case basis. This case-by-case basis leaves some swap dealers to have an exemption at one level, other swap dealers to have it in other levels. Some date back to 1991 and have been disclosed because of some historical reasons, but most have never been disclosed, and in fact, legally, we can't even currently disclose them. I think that the proposed rule appropriately seeks for the first time to bring uniformity to the swap dealer exemptions. And I share the view that Commissioner Summers raised in her closing statement that I think if we were to move forward on this, it would be wise to look to do this for all swap dealer exemptions, not just in the energy space, and we do ask a specific question in that regard. Swap dealers, of course, as described, would be required to file an exemption application and update that application once a year and update their information once a month. Exempted swap dealers also would have to be required to provide reports that demonstrated the specifics as to how they were using that exemption. And speaking to Commissioner Amalia's comments, I share your view. They would actually have to have that detailed record keeping of those that information. The CFTC further, under the rule, would publicly disclose after a 6-month delay the names of those parties that wish to be exempt under a swap dealer exemption. So overall, I think it brings a great deal of uniformity and consistency to swap dealer exemptions, which to date have been more on a case-by-case or ad hoc basis. Today's public meeting, though, is just one step in a very important process, and I look forward to hearing from hedgers and speculators, dealers and exchanges, other market participants, and yes, Jeff, economists, regarding the proposal and how and if it would improve the functioning of the markets. That is the critical role and the critical question that I'm looking for, how and if it would improve the functioning of the markets. I'm also interested in hearing any changes that may be suggested along the way. As we vote on today's proposed rulemaking, we also are working with Congress to bring comprehensive reform to the over-the-counter derivatives market. And I think all 4 of my fellow commissioners have raised this as a very real challenge for us. I was pleased that the House of Representatives included in the recently passed financial reform package enhanced authority for the CFTC to set aggregate position limits for over-the-counter derivatives when they perform or affect a significant price discovery function with respect to regulated entities. And while Congress continues to work on regulatory reform, I believe it's important that the Commission continue its work under current authority to consider setting energy position limits. But the CFTC is going to be working in parallel with a very important legislative process. So again, I want to thank the staff and my fellow commissioners for all the preparation that went into today's meeting. I want to thank the public, because over the next 90 days, I'm sure many people will weigh in, and that will be critical to our further deliberations. I think I've already entertained a motion and had it was forwarded by Commissioner Chilton and seconded by Commissioner Amalia. And with that, I think that I will call a vote, though everybody sort of stated already, but I will call a vote on the motion. So all those in favor say aye. 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 Any opposed? Nay. Nay. The ayes having it, the motion carries, and the rule should be sent to the Federal Register Secretary at Staywick. Are there any other further things for the good and welfare? Do I hear a motion to adjourn this meeting?
I move we adjourn.
Second. All in favor? Aye. I thank everybody.